And August has been a pretty volatile month so far for equities. And with all of the recent volatility in the markets, some investors may be stockpiling cash. But is that a good idea or a mistake? Joining us now to talk about the right cash strategy for you is Christine Benz. She is Director of Personal Finance over at Morningstar. Christine, welcome back. Nice to have you here.
Sue, it's great to be here. Thank you.
And you say, first and foremost, you have to look at a couple of key factors, where you are in terms of your life stages, correct?
That's right. So working people who have a regular salary need much less of a cash cushion on an ongoing basis. I think they can fall back on the usual 3 to 6 months worth of living expenses. And you probably don't want to get too tactical if you're a long-term investor with a long time horizon until retirement. You probably just want to hold a fairly skinny cash cushion and keep the rest of the money working for you in long-term assets.
Retired people?
Retired people need more of a cash cushion, in my opinion. So I like the idea of 1 to 2 years worth of portfolio withdrawals in cash. So in retirement, you're probably getting income from some other sources, whether Social Security or a pension. But the amount of money that you would normally take out of your portfolio, I would keep 1 to 2 years worth of those withdrawals in cash. The idea is that Armageddon could occur with the stock and bond markets, but you would have that cash reserve set aside to meet your living expenses. And I think that can provide a ton of peace of mind in volatile times.
There's that middle sector, though, those who work in the gig economy or the sharing economy, where working may not be as consistent as it is in other places. If you're an independent contractor, what do you do then?
Those paychecks can be really lumpy. Some of those gig economy workers can be quite highly paid, but there I think you do need to set aside a larger emergency reserve. It seems like a heavy lift, but I do think that 1 year's worth of living expenses in cash instruments, and this can be a variety of accounts, CDs, money market accounts, and so forth, but 1 year's worth of living expenses seems reasonable. That way, if you do get caught in some sort of an income disruption, you'll have at least some of your living expenses set aside. So I think that that can provide a lot of peace of mind. And again, you won't need to raid your long-term retirement assets.
Very quickly, should individual investors think of cash the same way money managers do? Professional money managers often go to cash because they're worried about the markets or, whatever. That gets into market timing. What about individual investors, though?
I think they can fall into that same trap, but individual investors seem to like the idea of retreating to cash in volatile markets, and it does provide sort of a short-term relief. But the problem is that's replaced almost immediately with a nagging sense of, is it time to get back in?
Right.
And so you've kind of swapped one worry for another. I think it's a loser's game. Even professional money managers have trouble pulling those bets off with consistency.
On that note, Christine Benz, thanks so much, Christine, with Morningstar.
Thank you.